Let's talk about increasing insurance deductibles. It's a great strategy when you're sick and tired of paying too much for insurance. My name is David Safir, and I teach organizations how to implement cash flow strategies. And I do the same with accountants and bookkeepers. I teach them how they can implement cash flow strategies with their clients and earn a pretty good living doing it. Remember, hit subscribe below and follow me so you can get the hundreds of cash flow strategies that I've developed over the last years. Let's talk about increasing your insurance deductibles. Now, why would you want to do that? First, let's talk about what is an insurance deductible. An insurance deductible is the amount when you have a claim that you have to pay out of pocket that the insurance company won't pay for. Let's take an easy example. You have a car and you get into a car accident and there's $10,000 of damage that the insurance company identifies. Yep, you have $10,000 worth of damage. If your deductible is $500, they will write you a check for $9,500. You have to make up the additional, that's your deductible. In other words, they deduct $500. Now, what if your deductible is $1,000? Well, you start out with that same $10,000. Now you deduct $1,000. They cut you a check for $900. Now, for some of you, this is really obvious, but just stick with me because increasing your deductible could really save you a lot of money. Now, it's counterintuitive. Wait a minute, when I get into an accident, I want all the money I can get. Yes, but you are paying for it in your premiums. And oftentimes there's a huge difference between a $500 and $1,000 deductible that you would make up within a couple of years of reduced premiums. When you say, you know what, I don't want to pay the $500 deductible, I want to pay for a $100,000 deductible, your premiums can be lowered significantly. It's simple math. For a $500 deductible to $1,000, that's $500 less you'll get reimbursed. But if you only get into an accident once every 5 years and you're paying an extra, I don't know, $250 a year for the deductible, you have now spent 5 times $250 more, which is $1,250 more to get $500 more in a check. Now, this is hard to follow the numbers, maybe in your head. I might be talking a little bit too quickly, but here's the basic concept. Go back to your insurance agent. Say you want the exact same coverage, but give me quotes with higher deductibles. And then have a discussion with them. Look at the difference and say, okay, the deductibles are getting higher and higher, which means I've got to take cash out of my pocket if I have to repair something, if I have a claim. But then look at how much these premiums go down. Now, I can tell you some of my insurance, for example, my car insurance, I have a very low deductible. Why? Because it costs me like $10 or $20 a year to have a $500 deductible versus $1,000, which means it would take 20 or 30 years going without an accident before I make up for it, which, hey, I'm not a perfect driver. It's a very low cost to with the risk compared to the risk. However, other deductibles, my house, I've got a much higher deductible. Why? Because we don't have claims very often, and it lowers my insurance premium significantly by having a higher deductible. Now, one of the biggest things to keep in mind is how much you have in cash reserves in case something happens. So it's one of these paradoxes. If you don't have very much money, you sort of want to pay more for premiums because it could be a real problem, not just a challenge, but a problem to you and your company if you have to pay a very high deductible if there's an accident, right? You've got a truck, you've got a building, and you have a fire. It's bad enough, but to have a large deductible and you don't have cash reserves, that could put you out of business. But so unfortunately, when you don't have cash, you might be paying more because you want to make sure you've got enough to pay that deductible. But once you get good cash reserves, then you are sort of self-insuring, and then you can really look at higher and higher as you go. And higher what? Higher and higher deductibles, which are going to lower your premiums more and more each time you raise the deductible. This isn't for everybody, but it's a great thing to look at. Why? I'm going to explain to you how this strategy breaks down into the benefits for you and your company. So, what are the benefits? Number one, you get to make the decision. You're buying insurance from the insurance company, but they don't decide for you your deductible. You get to decide. So that makes it nice and easy to implement. This is extremely easy to implement, and it can be done maybe in hours, but it probably is going to take you a few days. Not because it actually takes you days of work, but you got to call the insurance agent. It probably takes some time to get the quote back, and then you're going to want to do some calculations, but it's fairly easy to do. And if you don't know how to do it, then please ask your insurance agent. They should be able to help you analyze this. If you're a business owner and you don't do the math, well, great. Then talk to your accountant about it or your bookkeeper. They should be able to do this for you. So this will actually do two things. It'll manage your cash flow, because instead of paying out, you could, here's a strategy, a sub strategy, put the difference in the premium into the bank every single month or every year, depending on when you pay your premiums. So that way you can build up the cash reserve. So it's a cash management strategy, but it's also maximizing your cash flow because you're never going to pay the premium. And over time, there's a chance if you're very accident prone, it's going to cost you some more money, but most of you are not. So let's go past that. It will actually increase your profits. So mindset, that's the biggest thing, is where's your brain at? Do you feel afraid? And this is all gut feeling. Half the time, there might be some obvious choices. Like for me, the choice to take a $500 deductible instead of $1,000 for my car was an obvious choice. It was also obvious not to drop the $250 deductible because it was super expensive. Sometimes it's obvious, but sometimes it's just, what are you comfortable with? And this might be something that's new to you. So you might want to think about this a little bit more. If you've got questions, ask me a question in the comments and I'll get back to you. So this is implemented by the purchasing department. Now, if you're the business owner, you might want to get directly involved, and a purchasing department's going to know the real key insurances where senior management should get involved. This is actually a root cause strategy. What do I mean by that? This allows you to fundamentally shift costs lower. And anytime you can make a one-time change, this is permanent, and shift your costs lower, that helps you increase your cash flow permanently, which is always a good thing when it's permanent. You can implement this strategy every time you renew your insurance, or every time you have to pick up a new insurance. You should be thinking about this particular strategy. You get the benefits short term. You should be getting the benefits long term as well, because you only pay less if you don't have to use your insurance, and the calculations work out. If you enjoyed this video and you want to have more strategies available to you, then great. Remember to subscribe. If you liked it, you gotta press like, please. That's how I get paid, is by knowing there's people out there who are liking my videos. And of course, I already mentioned, leave me a comment in the comments or ask me a question if you've got questions about this strategy or any strategy at all for managing and maximizing your cash flow.